Welcome to this Nedbank Financial Markets educational series proudly brought to you by our online share trading division. In this educational series, we will discuss various topics related to financial markets. Learning about trading and investing is essential for every client, as this will equip you to make more informed personal trading and investing decisions. As a client, you want to make money. However, there's more to doing this than meets the eye. In this session, we will discuss the basics of financial markets. It is important that you should have a clear understanding of the type of instruments available and the different markets before making any trading or investing decisions. We are going to start our discussion on the basics of financial markets. We will continue by discussing what is an index and will highlight the different types of indices that you need to keep an eye on when following the equity markets. Please note that this session is on both a beginner and intermediate level. Before we start, let's review our disclaimer. In summary, you cannot regard this session as any trading or investment advice, as it is provided for educational purposes only. Let us commence the session. Let us discuss the basics of financial markets. The term market refers to a place or group of places where people can exchange goods or services for money. There is, of course, the basic market drawn from medieval exchanges where buyers and sellers would gather to exchange money for goods. Today, there are all sorts of markets ranging from the supermarket that sells our everyday food and household products to the art market, the real estate market, and even the second-hand market. Our current financial markets are generally named based on the types of goods or assets that are traded on them. The most well-known and most commonly traded are the equity market, the fixed income market, the commodities market, the currency market, and the derivatives market. Each of these markets have a range of instruments that are traded on them. The equity market is the financial market most people are familiar with. The name comes from the fact that a company's value is known as its equity, and it can sell parts of that equity to investors. These parts of its equity are known as equity shares or stock shares, and hence we have the expression buying shares on the equity market or owning shares of a company. These shares do not pay any interest. The value of the shares in the equity market go up and down. Those who buy them are counting on the value going up so they can sell them at a higher rate. The equity market is divided by company size or measured by capitalization. It is also split into industry or type of growth pattern. Investors and their advisors therefore talk about large cap versus small cap shares, energy versus technology shares, or growth versus value shares. The fixed income market is comprised of bonds, notes, and certificates of deposit. The fixed income market is called that because, unlike equities, the securities on it pay interest or income to the holder. It's also referred to as the bond market. Each instrument is issued at an interest rate that will be paid to the holder over time or at maturity. Companies or governments issue bonds to fund their day-to-day operations or to finance specific projects. A bondholder, in essence, is lending money to the issuer of the bond for a fixed period of time, which is until the maturity date of the bond. The underlying value of the bond may change during the course of holding the bond. If the bond was issued with an interest rate or coupon of 8%, for example, and interest rates on other similar bonds are being issued at 10%, this bond will become less attractive to other buyers and will become less valuable. This is not an issue if the investor intends to hold onto the bond until maturity, but if they wish to sell the bond at some point before it matures, the face value may be less. It may also be more. If the interest rate on similar bonds went down to 6%, a bond paying 8% would be more valuable. The commodities market is comprised of promises to buy or sell goods such as wheat, oil, and gold. This market evolved from the 19th century Midwest market, where farmers, who were the sellers, and dealers, who were the buyers, committed to future exchanges of grain for cash. Farmers gave up any potential increase in the price of their crops for the security of knowing their crop was sold for a set price, even if the bottom fell out of the market. In time, these contracts became a market of their own, as they changed hands before the delivery date. Before long, traders who had no intention of ever buying or selling a crop, but who thought they could outguess how the price of the commodity would perform, were trading commodities for the potential profit. The currency market, also known as the foreign exchange market or the forex market, is where companies or governments that need to settle their debts in another currency can obtain that currency. For example, if the owner of a shoe store in the United States wants to buy leather goods from South Africa, he will have to obtain South African rands in order to pay for them. Or the manufacturer in South Africa may accept the dollars but have to sell them for rands when he receives them. Banks and brokerages perform this exchange service. And in addition to charging a fee for the service, they will also try to make money off the fluctuations of the various currencies that they exchange. Just as with the commodities market, the attraction of buying a currency at a low rate and selling it higher appealed to speculative types, and today the currency market is dominated by speculative traders who never actually use the currencies they buy and sell. The derivatives market is made up of forwards, futures, options, and swaps on all the underlying products in the aforementioned markets. Both companies and governments, when faced with the increasing risk of issuing equities and bonds or covering commodity or foreign exchange positions, have decided to manage or reduce these risks and to hopefully increase returns. The derivative market is an intensely complex market wherein almost any aspect of debt or risk can be broken away into separate trading instruments and bought or sold. These sales are made on the basis of a guaranteed future sale at a current price, which is known as the underlying price. For example, the company that issued the 8% bond in our fixed income market example may want to manage the risk of that 8% bond if the interest rates go down by selling off the coupon on the bond and financing it at lower rates through the use of a derivative. Now that you have some knowledge on the basics of financial markets in general and the equity market in particular, it is time to discuss the concept of an index and which equity indices you should keep an eye on. An index is a method of tracking the performance of a group of assets in a standardized way. An index measures the performance of a basket of securities intended to replicate a certain area of the market. These could be a broad-based index that captures the entire market, such as the Standard & Poor's 500 index or the Dow Jones Industrial Average, or a more specialized index that tracks a particular industry or segment. In South Africa, the JSE All Shares Index is an example of this type of index. The next thing to consider is what indices should you follow to keep track of the markets. Our focus will remain on the equity indices, but the same principles will be applicable for other markets. An equity market index is a selection of shares. They are used by analysts and traders to compare returns on share prices. By tracking a selection of shares, they can interpret the state of the economy. Equity market indices can also indicate the health of the equity market and provide greater business confidence, which is vital for a well-functioning economy. Simply put, if an equity market index is performing well, investors will continue to invest via pension funds, insurance policies, private equity, etc. This drives up confidence in the equity market and boosts the economy. If there is no confidence in the equity market index, then investors will reclaim their money and invest elsewhere. There are many different types of stock market indices. Many of them you will have likely already heard of. The three most common types are global, regional, and national. Global equity market indices are made up of equities from companies located around the world. This is advantageous because it means that you are not reliant on one specific economy. Here are some of the major global equity market indices. As a global equity market index, the FTSE or World Index covers approximately 3,900 equities from across 50 countries. It is inclusive of developed and emerging markets and is based on large and mid-sized companies from around the world. It is believed that the FTSE or World Index covers approximately 90 to 95% of the investable market capitalization. The S&P Global 1200 has access to approximately 70% of the global market. It covers 31 countries and comprises 7 regional indices. The S&P Global 1200 covers a wide range of sectors, including financial, consumer, healthcare, and IT. Regional equity market indices are based on groups of shares from specific geographic regions. They can be used to see how different areas around the world may be performing, for example, Asia, Europe, or Latin America. Here are some of the major regional equity market indices. S&P Asia 50 Index tracks 50 of the largest companies located across Asia, including Hong Kong, South Korea, Singapore, and Taiwan. Notable firms tracked on this list include Samsung Electronics, Hyundai Motor Company, and China Mobile. Eurostoxx 50 Index looks at the top 50 blue-chip companies found within the Eurozone. It was first launched in 1998 and is popular with investors who are keen to follow equity investments from across Europe. Companies tracked within this index include LVMH, Moet, Hennessy, Louis Vuitton, Siemens, AG, and L'Oréal SA. As you may expect, national equity market indices are based on a selection of equities from one specific country. They are often a good indicator of the health of that country's economy. National equity market indices can also be used to track emerging markets where countries are experiencing a flourishing national economy. Here are some of the major national equity market indices. The UK FTSE 100 index tracks the 100 companies listed on the London Stock Exchange. It features many globally recognized brand names and is one of the most popular exchanges in the UK due to the diverseness of the type of companies included within the index. Investors are attracted to the FTSE 100 because the stocks are often international, allowing traders to benefit from global economies. There is also good liquidity amongst the firms listed on the FTSE 100, and historically there has often been a good return on investment. The US Dow Jones Industrial Average Index is one of the world's oldest equity market indices. It was launched in 1896. This index follows the industrial companies listed on the US stock market, which historically made up a significant part of the US economy. As the Dow Jones Industrial Average Index only follows 30 companies, it is not as influential as it once was. Instead, it has been replaced by the S&P 500, which tracks a larger group of stocks. However, it is still referred to by investors to compare the performance of the US economy over the past century. The three most widely followed indices in the US are the S&P 500, the Dow Jones Industrial Average, and the Nasdaq Composite. Our domestic JSE All Shares Index is also a national equity index. We have reached the end of this session. This educational video was brought to you by Nedbank Online Share Trading. Any examples used in this session are purely for illustrative purposes. Thank you for your time.